Let me start with something that shocks a lot of buyers. You can buy a $500,000 house and still be completely unprepared for closing day. Not because you didn't have the down payment, not because your loan was denied, but because of something most people don't fully understand. Closing costs. Almost everyone has heard of term, but very few people actually understand what it means. I have seen buyers feel completely confident about their numbers, only to discover 2 weeks before closing that they need thousands more than expected. And sometimes it's not because the lender made a mistake, it's because nobody ever explained the entire system clearly. So today I want to walk you through something that most buyers never really get a proper explanation of. What closing costs really are, who charges them, what you can negotiate, what you can't negotiate, and how smart buyers prepare for them. Because once you understand how closing costs actually work, you start seeing the entire real estate transaction very differently. And later in this video, I'm also going to show you something most buyers never notice on their loan paperwork. But it quietly reveals where a lot of money can disappear if you are not paying attention. So let's start with the basics. When people hear the words closing costs, they often imagine a single fee, like a large charge that just appears at the end of the transaction. But that's not actually how it works. Closing costs are really a collection of many smaller fees, and those fees exist because several different organizations are involved in a real estate transactions. You have the lender, you have the title company, you have the government, you have insurance providers, you have the appraisal company, you have credit reporting agencies. Every one of those organizations performs a specific service, and each service has a cost attached to it. Those individual costs get bundled together, and the bundle is what we call closing cost. Sometimes that bundle contains 15 separate items, sometimes it contains 20, sometimes even more. And here is where buyer often gets surprised. Some of those costs are absolutely unavoidable, but others are sometimes negotiable. Most people never realize that. Now, the next question everyone wants to know is the obvious one. How much are closing costs? In most transactions across the country, closing costs usually fall somewhere between 2% and 5% of the purchase price. So if someone is buying a $500,000 home, closing costs might land somewhere between $10,000 and $25,000. Now, before that number scares anyone, I want to explain something very important. Not all of that money is actually transaction fees. A large portion of it is simple prepaid expenses, which means it's money you would have paid anyway. The lender is just collecting it earlier. For example, many lenders require the first year of homeowners insurance to be paid at closing. That money isn't disappearing, it's simply paying for your insurance coverage. Another example is property taxes. Depending on the time of year you close, the lender may collect several months of taxes in advance. Again, that's not a mysterious fee. It's just setting aside money for a bill that will arrive later. Understanding this one detail alone often changes how buyers feel about closing costs, because what looks like a giant pile of fees is actually a mix of transaction costs and prepaid obligations. Now, there are several major categories inside closing costs. One category involves lender charges. When a lender gives you a mortgage, they perform multiple services behind the scenes. They review your credit, they verify your employment, They analyze your income. They structure the loan. They process documentation. They underwrite the risk. Those services come with things like loan organization fees, underwriting fees, and processing charges. Different lenders sometimes label these fees differently. That's why two loan estimates can look completely different, even if the loan itself is very similar. But here is something interesting. There is actually a section inside the loan estimate that tells you almost everything you need to know about the lender fees. Very few buyers ever look closely at it. Later in the process, we will talk about where that section is and why it matters. Another major group of closing costs involve the title company. The title company performs one of the most important roles in the entire transaction. They confirm the seller legally owns the property. They search public records to make sure there are no liens attached to the home. They prepare the closing documents. They hold escrow funds, and they record the property transfer with the county. Because of those responsibilities, you will see things like title search fees, escrow fees, and title insurance. Title insurance is another thing many buyers misunderstand. Unlike health insurance or car insurance, title insurance is usually paid one time at closing cost. It protects you from ownership disputes or hidden claims that might surface in the future. Then there are government recording fees. Every property transfer must be officially recorded with the county. Those recording charges are not negotiable. They are simply part of the legal process transferring ownership. Now, another group of charges involves escrow reserves. Most lenders require an escrow account. That account collects small monthly amounts from your mortgage payment for property taxes and insurance. When those bills come due, the lender pays them from the escrow account. To create that account, lenders usually collect several months of reserves at closing. Again, that money isn't disappearing, it's simply being stored to pay future bills. Now, here is something interesting. There are three closing cost items that buyers almost never question. But in certain situations, they absolutely should. We will talk about those in a moment. But first, let's address another question buyers often ask. Who actually pays closing costs? The simple answer is both buyers and sellers have their own closing costs. Buyers typically pays lender fees, appraisals, insurance prepaids, and escrow reserves. Sellers, on the other hand, usually pays agent commissions and sometimes title-related charges depending on the market. But this is where negotiation become interesting. In some transactions, the seller agrees to contribute money towards the buyer's closing costs. This is often called seller concessions. Seller concessions can significantly reduce how much cash a buyer needs at the closing table. And in slower markets, this becomes a very powerful negotiation tool. Now, before we continue, quick pause for a second. If you find explanations like this helpful, consider hitting the like button. It helps the video reach more buyers and sellers trying to understand the real estate process. And if you are new here, please consider subscribing. Every week, I break down how real estate transactions actually work so people can make smarter decisions. Now let's continue. One of the most important documents you will receive during the home buying process is something called loan estimate. Your lender is required to provide this document shortly after you apply for a loan. Inside that document, you can see almost every major category of closing costs. But here is the interesting part. Most buyers only look at one number, the total. What they should really examine are the individual sections that list lender charges. Understanding that section alone can sometimes save buyers thousands of dollars. Now let's talk strategy. Because smart buyers don't simply accept closing costs blindly, they manage them. Some buyers compare multiple lenders, some negotiate seller's concession, some evaluate lender's credit, some compare the companies. Each of these decisions can influence how much money is needed at the closing. But there is one mistake I see buyers make repeatedly, and it can increase closing costs dramatically. That mistake involves the relationship between interest rate and upfront costs. Sometimes buyers choose a very low interest rate, but that lower rate requires paying higher upfront fees. Other times, buyers accept a slightly higher interest rate and receive lender credits that reduce closing costs. Neither option is automatically right or wrong. The correct choice depends on how long someone plans to keep the loan. Understanding that trade-off is one of the smartest financial decisions a buyer can make. Now, as the transaction approaches closing day, buyers receive the final document called closing disclosure. This document confirms the final numbers. Inside that document, there is one number that matters more than anything else: cash to close. That number tells you exactly how much money must be wired or brought to the closing to complete the purchase. Once buyers understand how that number is calculated, closing day becomes much less stressful. And if you are currently thinking about buying or selling a home and want guidance through the process, you will find my contact link in the description below. And if you are moving outside my local area, I also help connect people with excellent agents across the country through my referral network. You will find that referral link in the description as well. If you want an additional guidance about buying or selling, I have also put together free buyer and seller resources that explains the process step by step. Those links are in the description too. Alright, let's move forward. Closing costs are one of the most misunderstood parts of real estate. Not because they are complicated, but because most people only hear about them briefly. Once you understand the categories, the fees, the negotiation opportunities, and the strategy behind them, the entire transaction starts to make a lot more sense. And when the buyers understand the numbers, they move through the process with confidence instead of confusion. Hope this video helped you understand the closing cost a little better. Alright, I'll see you guys in the next video.